And so the covered call, when we're using a covered call, it's considered a neutral strategy. And it's considered neutral because a lot of times when someone selects to put on a covered call, it's because the expectation is that the stock is going to trade in probably a small range, right? And within that small range, we might expect it to go up to whatever strike we've selected, or it might go down a little bit. But the point of all of this is that we are going to collect whatever we sold, whatever that amount of premium we collected from selling that call option. So a couple of things to note about selling a call option. One, strike price selection is key for doing a covered call. And I say that because it's important to know how much you're generating, which is what you've sold it for, but what happens if the stock goes through your strike? So one of the decisions that you will be making is, I am selling this call to generate income, right? And by doing that, I am forfeiting my upside potential, meaning when the stock goes through your short strike, that is, you have optimized how much you could potentially make in that covered call. Now, that covered call profit is the difference between where you purchased the stock, where you sold the call, and how much you've collected. But I just want you to keep in mind, by selling that call, you have forfeited profits if it were to go above that strike price. So when we're selecting, anytime we're selecting a strike price, and especially when we're selling an option, it gives you an obligation to fulfill whatever is in that contract. And in case of a seller, and in this case, if we're selling a call option, it is going to obligate us to sell stock to the buyer at that strike price, which also means that you are selling potentially your existing stock position to that buyer of that option. So I want to keep that absolutely forefront when you're deciding to do that. It's because there is an element of risk that if you're holding stock, that you could lose that position if you were assigned on your call. Now, downside, when we're looking at our downside risk, the downside, the one thing that you get from that premium is it offsets your downside risk. Now, does it offset it so that you have no risk? No. It just offsets it enough for whatever amount you sold that option for. Now that effectively, your loss starts at wherever you purchase that stock minus the amount of premium that you collected. And so we're going to go through that in these next couple of slides, but those are the points that I want to make when you're looking at a covered call. And here's the structure of a covered call. Again, every option's worth 100 shares. If you have 100 shares, you would sell one call option against it. If you have 500 shares, you could sell 5 call options against it. Typically, people sell out of the money calls, which makes a whole lot of sense because you still want some potential in there. You want to give it some room to make money when it goes up. Now, this strategy is considered neutral to moderately bullish. The maximum risk is the long stock, right? The long stock position minus whatever you collected. So if it goes down, That's where the starting point of your lawsuit begins. Maximum reward is the difference between where you bought the stock, the strike that you selected, which is likely is going to be an out of the money option. So whatever the difference is, plus whatever premium you collected, that is going to be the max risk, the max reward. And then of course, there's always assignment risk, like I mentioned earlier. So let's look at an example of this covered call.